Stocks trade on their perceived value, not necessarily their true value. In this video, I want to break down how the stock market actually works. I want to talk about something that most financial channels actually never really talk about, and that is short interest and actually how the market works. I think if I explain and pull back the curtain on how it works a little bit, that will reduce a lot of fear, especially with the volatility that we see right now. And it may make you rethink your portfolio, rethink the moves that you do make. And so sometimes we're overburdened with information. And so in this video, I'm going to try to break it down in the easiest way that I can. I'm going to be using my notes as well. But I wanted to talk to you about the market. And so generally, stocks trade based on their perceived value. So it could be things like their price to earning ratio. What's the price of the stock? How much earnings do they get per share? And generally, if that falls in a very good range, companies will be considered valuable. And then there's their forward price to earning ratio. And so there's formulas for these. Their price to earnings to growth, which is called the PEG ratio, and that's used to balance the price with the actual growth of the company stock itself. A lot of individual investors, retail investors, the you, the me, who are not invested with a hedge fund, generally we go long a stock. We buy in and we hold on to that stock, and the hope is that that stock will go up. We are considered to be long-term investors when we are going long the market. So we're considered long. But there is such a thing called shorting the market. And these same metrics that you use to figure out whether a stock is worth it or not is used to short the market. And generally, the market has about 2 to 4% of the overall market is shorted, maybe 2 to 5%. I'll actually have to look at my notes as I'm going through this. But when a company is looked at by investors, by hedge funds, by individual investors who are picking stocks, if they're looking at the fundamentals, they're actually checking to see whether or not it makes sense for you to buy that stock, right? And sometimes the company's too new, that they have no earnings yet. So this is when Facebook first came out or when they go IPO. And it's not really 100% clear how much money they can make, but people perceive that they're going to be worth a lot in the future. And so their valuations, it's a little bit harder to tie down. Sometimes those valuations are still considered wrong, and that's when shorting the market comes in. So let's talk about going long, which is what retail investors do. So I'm going to take the stock is $100. This is me. The stock is 100. I'm a retail investor. I'm buying Apple shares at $100 a share. Let's just pretend it's $100. So $100 a share. I buy 10 shares for $1,000. Now, a hedge fund could do the same thing, but they could just buy a lot more in quantity. But they're buying that same Apple share for $100 a share. They could buy it and go long, and when it goes to 200, I could make double my money. That's 100% gain, right? That's me. It's going up. But if the value goes too high, the market, if it only went long, then what would happen is eventually you could be trading on fumes. If the market only went long, because eventually it can go to 2 to 3, and it's almost like what's going on with Bitcoins, basically. There's nothing to stop it except the perceived of what people are willing to pay for it. And so it can drop really drastically. But in our overall market, there actually is something to stop the stock from going higher. And that is with institutional investors and hedge funds shorting the market. And so instead of going long, they go short. They go to a like an institution that carries the funds or sells it to you and me, they could only go to someone who has the shares and they buy them on margin. And so let's say it's trading now at $200 a share. They perceive it's overvalued, right? They buy contracts to buy, and they're given the shares at $200, but they're going to have to return them at some point. And if they return them at $100, they made 100% profit. Now, the only place the stock could go to is zero. So the most amount that they could make per share is $200 because the $200 stock can only drop to zero. You only get paid this way. Whereas if the market goes up, in theory, you could be paid infinite because this could go to 1,000, 2,000, 3,000, 5,000, and it could have a short squeeze and go really high. And we'll talk about that too. But when you short the stock, there you have a limited return on how far you can go down. But what ends up happening is if the market is overvalued, and a lot of companies, particularly in the market we're in now, with tariff, with geopolitical risk, trade wars, all that's going on in the market could affect what Apple earns. And so what is happening now is you are having hedge funds come in and short a lot of these companies who have risk. Now, the problem with shorting is, and why an individual investor doesn't want to do, is what happens if this goes to 1,000 and they're called to buy in their shares. Now they lost $1,800 a share. Instead of the 200 that the most they could gain, they would have lost 1,800 because of a short squeeze. So shorting the market is only really done from the big guys. I mean, you could buy puts, but that's something different. That's like contracts to buy. But in general, puts are safer because you're going to have, there's a cap that you could lose. But most retail investors go long. And that means they're buying they're buying the stock and they're expecting the stock to go up, and they're buying it based on the perceived value of the stock. Now, there are times when the perceived value of the stock is great when you look at the fundamentals, but institutional investors may not agree. They may not think that the price to earnings growth is there. Like, I'll give you a situation in this. So Peloton came out IPO, and back during COVID, they were selling the bikes like crazy. And so their valuation, it kind of looked good on paper, but it was being priced in that they were going to have the same amount of sales that they were having during the COVID times. And that just wasn't true because demand was going to fluctuate. The demand could not stay constant. So it's a very different story as opposed to when Apple back in the 2010 to 2013 range, when the valuation of Apple went really super duper low. And until an institutional investor perceived that the stock would go up, it took a while for it and it stayed low. So their price to earnings ratio, I think, was somewhere around 10 to 11. And generally, stocks price to earning ratios, their PE ratio usually is around, well, the overall stock market is around 18 right now. Now, generally, a 10 and 11 is really considered great value if the growth is going to be there. But if it isn't there, it may be that their PE ratio is extremely low because people are expecting the company to fail. There's no future customers or things like that. So you have to look at the overall picture. You have to look at the value of the company, the true fundamentals. Look at the books, the paperwork, the cash flow, how much cash they have on their books, how much debt do they have? Is there Is there a market? Is that business understandable? How is debt? Is insider selling rising within the company? So insider selling, sometimes they have the standard times that they're going to be selling, but sometimes they perceive something might be happening, and so they set these contracts in place to sell. But as a long-term investor, you're going to be looking at the fundamentals of particular stocks that you buy. Now, I do not recommend buying individual stocks. I think that's too risky. And it's particularly risky in a time like this. So that is why I invest at this point in time in my life. Well, also because my employer doesn't allow me to invest in individual stocks. But at this point in my life, I am not looking at every single company's fundamental value. I am not analyzing their books. There was a time and a place I used to do that, and I did very well because if you understand the fundamentals, you can be buying companies that are undervalued. And back in, after the 2008, 2009 crisis, there were a lot of companies that were undervalued. So even though I did very well, it was just a matter of the time. So let's talk about short interest, and for me to try to explain it a little bit more, because short interest has been around a really long time, 400 years. And so the 1929 stock crash was based on short interest. A lot of that was one of the biggest reasons why shorting went, why the stock ended up falling. And there have been things put into place to make sure that the stock market doesn't fall as quickly, as fast, or as hard as it did back in those times. But that doesn't mean we can't see a major correction based on what's going on with the tariffs, based on what's going on with trade wars and geopolitical risk. So let's talk about short selling in general. Who benefits, how it works. So, how short selling pays everyone. So, let's say a hedge fund wants to buy XYZ company and it's trading at $100 a share. They borrow the shares from a broker, and the broker has to have those shares from clients like you and me. We have to have those shares within the account, but we're holding them, right? They'll be called back if we, in turn, want to sell, right? So the broker gets the shares from the clients who hold long positions, who are just holding it within. So if, let's say, I was holding XYZ and I was holding 1,000 shares, that hedge fund could go to my broker and buy from that and buy the shares. And so usually it's in a margin account. It can be that we hold it in mutual funds or ETFs, but generally they have the shares of all their customers having gone long the stock, meaning buying and hold investors. So then the short seller borrows the 1,000 shares, but they have to return it at some point. So they have to return those shares, and what they pay for the shares is going to depend at the time they return it. So if they sell those 1,000 shares at $100, that means that would be $100,000 in cash, right? But when they go to return it and it stays 100,000, they would give the 100,000 right there. So they're borrowing 100,000 from margin, and then they'd have to give it back. How the broker makes fees is they usually collect 0.3 to 0.10 annually, depending on how hard it is to borrow the shares. And then there's margin interest. If a short seller is usually leverage, most do, they pay interest to borrow the shares. And then the custodian lender, they get a small fee for the slice in the action. And so shorting the market, you have the broker companies making money that way too. Now, if the price of the XYZ stock drops to 70, the hedge fund decides, I'm going to return those $1,000 shares that you let me borrow, but now I only have to give you $70,000 instead of $100,000, right? So they profit $30,000 minus the fees. That's how they make their money. Now, if the price goes up to $150, they're going to have a $50,000 loss plus fees. in their account. So right now, in this kind of market, since you can't go long, hedge funds are going short. It's very difficult to go long. So let's talk about the different kind of crashes. Because of the kind of crashes we had in the past, like the 2008 crash, there have been rules put into place because of things that have happened. And so, regulatory and oversight. Everyone may have heard of the Dodd-Frank Act in 2010. It was created after the 2008 crash to prevent systematic risks. So there's tighter rules on derivatives and swaps, like the one used in the big movie, The Short. They were in The Big Short. They shorted the market by taking going to the banks, and I believe in that movie taking out insurance um, shorts. And if this and the banks gave it to them because they didn't think the overall market would fail. They're like, no, the housing market isn't going to fail. But the Big Short in that movie, they realized that a lot of um, the market was trading on fumes as the housing market was. And they were packaging up a lot of loans and selling that out in the market. And some of those loans were sold, obviously, to people who really couldn't afford a mortgage. And then, of course, when they defaulted on the mortgage, those became riskier. So the Dodd-Frank Act um, created a central clearinghouse for credit default swaps. You can't just make backroom insurance bets anymore. You can't do that. You can't bet outside because of what happened. Then there is the second short selling rule, and that is the uptick rule. This basically is short selling is restricted because back in 1929, when the stock market crash happened, there was no rule set in place that you continue to short, continue to short, continue to short. And when the market itself is pessimistic, then obviously the people that are shorting the market can only go to zero. But if everybody's scared and selling out, you're getting panic in the marketplace, and so it's going to continue to drop. But with the uptick rule, it basically short selling is restricted. If a stock drops more than 10% in a day, they're going to stop short selling. So you can't have a company fall more than 10% and other shorts continue to go on top and drag it down. And the reason for this is another thing that happens is when the stock is selling, the people who are benefiting is the hedge funds, right? And the hedge funds, whoever is invested in those hedge funds. The people who are losing sometimes are institutional investors as well, because what will happen is if a stock falls too much, they will be stop losses will be triggered. So there are certain institutional investors that if the price falls too much, they are legally obligated to get out and not lose all your 401k money. And so if a stock falls too much, it's going to trigger a stop loss, and then you're going to have institutional investors like the TIA crafts potentially get out if, let's say, they were invested in that particular stock, and let's say they have a stop loss set for 20%. Right? And if it fell to 20% in a day, then yeah, their stock loss might be triggered. And so the hedge funds can then cover and then rebuy the shares with that 20% gain. The other people they make more money on is from the retail investors that panic. That they're making it off the backs of retail investors who really panic, and they panic when the market is down, as opposed most people don't panic when the market is up. They get greedy. And most people panic when the market is down and they sell at a loss. And what they're really doing is allowing the hedge funds to then profit on the fact that the stock is going down, which they themselves are betting and pulling the stock down, and then people get scared and sell. So the uptick rule, but getting back to that, is you can only short a stock um, on an uptick. So after it falls 10%, you actually have to wait. And so you saw the other day, so Apple gained 10% in one day. And then all of a sudden, the next day, it went down because now people could still go ahead and short the stock. The hedge funds could short the stock and scare some retail investors into potentially selling down or locking in their profits. Let's say they bought it so many years ago and they just want out of the volatility. Now the hedge funds make money because they're getting you to sell your stock. Now, that doesn't mean that the stock will eventually go back to where it was. And it depends what's going on in the climate. If the tariffs come in, and we'll talk about that too, it could eventually affect these companies on their performance. And so that's why people are shorting, the hedge funds are shorting the market, because the market is taking into account the tariffs and what will happen, and that future price to earnings growth may not be there, that companies are not going to be selling as much. And so that is being taken into account. And so that's why you're seeing the pullback, because the market is being shorted. So the short interest goes up in times of economic uncertainty, and the people that are losing are the individual investors and some of the institutional investors as well in 401ks who hit rules, and they have to sell because it triggered a loss. Now that doesn't mean that they can't lower the stop loss. They can take into account and lower those stop losses. But what will end up happening is there will become a time when it no longer makes sense to short the market, when the valuation comes down to a level that companies can buy back their own shares. If their shares go down too much, you can have Apple, who at one point in time had $150 billion in cash. So back in 2013, they could buy their own shares, and when they initiated a buyback, the shares started to go up. And so companies started to, buy their own shares because they realized how valuable it was. And so, like for Apple sits on a huge cash reserve. They have a lot of brand loyalty. They have pricing powers, and they also have a diverse income. I'm sorry, revenue stream. So they're not just making their money on consumer goods. They make their money on cloud services. They make their money on insurance products that they're selling you. God forbid your phone breaks. Selling the phones themselves. They make it. They make it on now. They're making it on. Content that you're buying with Apple TV, and just things that you buy and rent, their music. So Apple has a lot of different ways that they make money. So they're more in their technology company, but they're definitely moved over into the entertainment field as well. So basically, that's how shorting works, and that's what's going on. Um, They used to allow negative shorting, and negative shorting is no longer allowed as well. So that is when they would go to a brokerage company who didn't even have the shares to in their account to loan. And so the hedge funds could then go and short a company's stock without without the brokerage even having the stock from long investors to sell. So that is no longer allowed. And then the other rules that are in place is banks must now have a higher reserve and undergo stress testing to prove they can survive these kind of economic shocks. When it comes to having enough capital requirement on hand, so that you don't have the instances with the bank failures going back in to the 2008. And then there has to be transparency in reporting when it comes to short interest. So now it's publicly reported biweekly on FINRA and the exchanges, so people could see how much short interest there is in a particular company. And they also have to have a large position in the credit market for swaps to be disclosed. So there is that. Now, it's been going on for over 400 years, shorting interests, and we can go into it. So in the Great Depression, short selling was heavily criticized after the 1929 crash, and it exasperated the market collapse because you had a lot of people going in short. But eventually, when the market went long, there's some people who lost their shirts because it you could have what happens as a short squeeze. And so I want to give you an example of what a short squeeze looks like. So a really great example is GameStop. So back in 2021, there at the time there was a hedge fund, Melvin Capital, that reported their short interest, and they reported in GameStop. And there was um, there was a Wall Street Bets. I was an online forum, I guess, and I believe that was an online forum, and they basically went after the hedge fund, and they were telling everyone under the sun to buy the GameStop shares. And so what ended up happening is it became like a tug of war between the retail investors and the hedge fund. And what ended up happening is, unfortunately, a lot of retail investors ended up losing their shirts as well, because when you buy the rumor and you sell the news, what ends up happening is the people who were in early, even when it was going long, these short hedge fund went that shorted the stock. Let's say the stock was trading at $100. Let's give the $100 an example again. And it went down to 14, and the stock went down to 14, but they didn't cover. They were getting greedy. They perceived that GameStop was going to fail altogether, and so they kept shorting the stock. Actually, I think they shorted the stock well below 14. It might have even been, somewhere. Well, don't remember the exact amount, but I think it was well under 10. It might have been $4 or $2. But anyway, long interest went into that stock, and retail investors started investing, buying shares on Robinhood and all the different sites. And before you know it, that hedge fund collapsed, because instead of having to pay back, maybe the stock started at 14 or wherever it was that it started at. Now, if it's trading at 200 and something dollars a share per share, that's devastating. It collapsed. I think they owed billions and billions of dollars with that hedge fund collapse. Let me look it up. I had it down. Okay. So they had Melvin Capital had a massive short interest in GameStop. They required 2.75 billion bailout from Seattle and 0.72 just to stay afloat. Despite the infusion of cash, they reported a 53% loss in January of 2021, and they struggled to recover. Melvin shut down in 2022 as a result of the fallout. But what happened is GameStop was so heavily shorted, around 140% of its available shares were shorted by institutional investors, mainly hedge funds, and they were betting the stock would fail due to poor fundamentals. It's just people weren't buying, spending money at GameStop. The future growth just wasn't there, and so sometimes it it makes sense to short these companies. Are not going to be existing, and if they're getting retail investors to go long a stock and the stock really has no value, so sometimes shorting a stock stops people from investing too much. But retail investors, primarily from a subreddit group, Wall Street Bets, noticed the unusual high short interest and began buying shares and options in masses to drive up the price. And then the short squeeze started to follow, and it forced short sellers to cover their position to buy back the shares at higher prices, which further propelled the stocks upward, because now people were not selling their shares to them. It's because people were just buying. So the short sellers, the hedge funds, were competing against all the people on the subreddit group that were trying to buy the shares. So everybody was buying the shares. But eventually, when it reached its all-time high, then people started cashing in and selling their shares, including the people who were long the stock. And so, unfortunately, some people, like retail investors, were left holding a lot of position, because eventually the stock could be shorted once again, and there was just nobody that was willing to buy the stock at 200 and something dollars a share at that point. The fundamentals just didn't make sense, and that's why the stock ended up coming down. But that short squeeze saga was a historic financial event, and it just goes to show that sometimes the David and the Goliath struggle of war, but short interest in general is not bad. A lot of people perceive that short interest in the market is considered so bad. But what would happen is if you didn't have short interest at all, then you could actually have the market go to a super high valuation that it would be trading on fumes, and that the valuation wouldn't be there. And then it would end just becoming a Ponzi scheme. And then it would become pure gambling if the value of every stock became just trading on fumes. So you do have to have that ebb and flow go on where there is short interest, so that the stock market does not continue to rise and rise and rise. The next thing that happens is um, back in the 1990s, 1980s to 2000, hedge funds exploded. So a lot of institutional investors started short positions, and there was all different kind of high frequency trading that was going on, things that you and I could not even do fast enough, that allowed short interest. Just give me one second. To beef up, and so that's why a lot of rules were in place. But it's been going on for over 400 years. And it's always been perceived as controversial, profitable, and also like a parasite. People consider shorting, some people look at it as a parasite, like, why are people making money? The parasite portion of it is the fact that they're scaring retail investors. That part is, and they go on these forums and they really, and if you would read these forums, these stock forums on, you'd get scared and into selling your own shares in companies that might have really good fundamentals. And so you can't have a president go online and say, hey, it's a good time to buy. That's probably really not a good thing to be doing, because it, it, it looks like you're trying to move the market. And I'm not political at all, but it could create panic selling in the long run, because then don't understand all this volatility that is going on. And so one day they see the stock having its best day ever and they think things are going to recover. And no, it's not going to recover completely, because the market is in somewhat of a correction right now because of what's going on. And the hedge funds understand that for them to make money right now, it means shorting the market, especially in areas of the market that their valuations are potentially too high if tariffs come into play, if there is trade wars going on, and with the geopolitical risk. And so I want to go into that. But now, if you understand that there is short selling going on and why short selling exists, then it will make you not as scared. But today's risk in the market, there are risks associated with buying individual stocks because of the tariffs and the wars. There's going to be compressed profits. Companies are not going to make as much because, yeah, they may share on the cost and push it onto the consumer. But what will end up happening is they'll end up selling less goods. So their valuations do need to come down a bit. Then you're going to have to worry about stagflation, and I'll go into what that is. But generally, that means slower growth, and tag on inflation with that, the cost of goods rising, and that means declining real earnings. So companies are going to face potentially uh, years of slower growth if we do have these tariffs that come in at these super high values. And I'll go into companies and how it is going to affect them as well. And then you have geopolitical risk, where oil prices, supply chains, sanctions going on, things that are happening that can affect how much profit these companies see. Now, again, when you're buying shares within a company, you're buying them based on their perceived value, what you perceive them to be. But there are market fundamentals. Now, it doesn't make sense for the S&P to be trading at a PE ratio of 18. I don't know the answer to that. Generally, that's considered a decent PE ratio, but it might not be at this time because of what's going on. But that doesn't mean every company within the S&P 500 is going to be affected. I think they said out of the 500 companies within the S&P 500, there was 259 companies in their earnings report that were mentioned tariffs and tariffs, the effects on their business. And some companies could not even forecast their future earnings. They didn't even want to forecast it because they don't know themselves on how it's truly going to affect. Now, it could be that it's affecting little components, and we talk about Apple and their phones and the chips within the phones, and those come from China, and those are going to be rising costs. And I'll go into that as well. But in general, companies are going to be affected because of what's going on. Now, there's some companies that are more vulnerable. So they'll go like consumer discretionary goods, um, like the Nike, the Starbucks, the Tesla, the Amazon, the cruise lines, the luxury brands. Why are they going to get hit harder? Because people are going to be tightening their belts, right? If things are costing more and they're potentially at risk of losing their job, people are going to start spending less, right? They only have so much money that's coming in, and if stagflation goes into effect, it could be that interest rates are kept the same. I'll go into that too. But that means that people are going to be tightening their belt. And so companies that are consumer discretionaries, they may be affected. They may not earn as much in the future if these tariff wars stay in place and if the tariffs are too high that the price of the goods go up too much. The next is financial companies. So you have um, the JP Morgan, the Goldman Sachs, the regional banks, the insurance companies. Banks suffer when interest rates are unstable. And so they could have loan defaults on the rise. They could have economic activity that slows down. And then obviously, if there's a market panic, which there has been a little bit, a lot of retail investors have been selling into this market. And then there's liquidity shocks, and then there's losses in their investment portfolios because of the changes in the interest rate and the changes in the dollar too. It's um, I don't think there will be quite the level of the 2008 panic because of certain rules that were put into place, but yeah, they could be affected if you were buying these individual kind of companies. The next is the technology sector. The technology sector during tariff wars could be affected as well, because um, high growth probably not going to happen, and um, they might become unprofitable in certain areas. And if they don't have a really good cash position, they could be in trouble if some companies have really high debt, and let's just say interest rates go higher, or the cost of their goods just adds to their debt load. That could create a problem. And then valuations are often based on future earnings, and so generally when you're looking at price to earnings ratios, a lot of it you're looking in the past, and now you have to think about the PEG ratio. How is the growth out there? What's the future going to look like? And a lot of companies don't know, and particularly with the technology sector, if the cost of their materials are going to go on the rise because a lot of those materials are coming from China, let's say, those industries could be affected. Now, big names like Apple and Microsoft, again, they have a really strong cash position, and um, I don't think that their stock will be as crushed as people think it might be. And I also think that a lot of their money is coming more. I haven't been looking at their fundamentals as of late, but a lot more of their money is coming from different sources of income streams. And then the next area that could get hurt is real estate. And this is particularly retail because generally what happens if it comes too costly for businesses to stay afloat, you might see some businesses, in this high tariff environment. Let's say they're getting their goods from China. If the US does keep the tariffs on China to be so high, then they could end up deciding to close down their business because of geopolitical and tariff costs going on their cost of goods. Now, what might hold up better if you were buying individual companies? And again, I don't suggest buying an individual company because you you you're at a much higher risk. But if you did, it would be more like the utilities. People are going to still need electricity, right? And so, but those are still subject to risk as well because of the climate changes and the things that are going on and the cost of repairs and with everything that's going on around the world. But in general, you're going to have the utility companies that are still going to be making money because people are going to need to keep their lights on, right? And so electricity, water, they don't get cut when everything else in the budget gets cut. So those kind of companies might do well. Healthcare companies that might stay okay as well. They may not drop as much as others because people still need their drugs. If they're People still need to take care of their health. That said, is if people don't have money to take care of the healthcare, they may not get as many new customers. So it doesn't mean that they won't be exposed to risk, but their risk could have already been priced in with this 20% drop that we've seen, right? So some of the shorting that's already has gone on has reduced what the S&P 500 is already trading at. So it could be priced in. And then other things that might stay stable in these kind of trade wars are consumer staples, things that people need. People still need to eat. So food that people have, soap that people use, toilet paper, things that generally, like, maybe they don't need to get the high ends, so they may still be affected. So the future growth of those companies might not be as robust as it was in the past. And so maybe they're not going to be buying the Pepsis as much, and then maybe they'll buy the fringe soda. But you could have some of those generic brands because of the cost to run those brands. Some of those companies of the generics could close down because it's just too costly for them to run. And so you might just be left with the more higher end brands, and they could end up doing well. And so then there also are wild cards, like oil and gas can go either way. And sometimes in a recession, if demands drop, prices fall, that's bad for profits, but then it can go the other way. If inflation goes too high, then energy prices surge. That could be good for the companies. Now, why do I still think the S&P 500 overall and why I don't worry? For one thing, I watch enough news to stay informed, but not enough that I get overwhelmed by it because a lot of it is driven by the media, and the media likes to sell fear. And I don't play along. I like to understand the fundamentals. I like to understand what's going on. But it doesn't mean that investing in the overall market is a bad thing. Number one, there's already been a correction. And so, yeah, I'm down quite a bit, but the money that I have invested is invested for a long term. And I'm still buying. I'm still dollar cost averaging every month in and out, as well as I have dividends coming to me. And I also have bond funds that buy me stock funds. So, and I'll talk about cash as well when I get to that point. But generally, the S&P 500 is what I don't think is spoken about enough is that it's the top 500 companies. And there are other exchange traded funds that you could buy that is more of the overall market. But what ends up happening is it's a self cleaning mechanism. And so by that, it means, let's just say Apple fails. And I don't see that happening, but I'm using a company that everybody knows it's in the S&P 500. There was a point in time where Kodak was in the S&P 500, when Sears was in the S&P 500. And so the S&P 500, the Standard & Poor 500 top companies, includes the top 500 companies. But there are companies that are going to fail if the tariffs remain so high. and there will be other companies that come in the S&P 500. And so things will be traded in and out behind the scenes. And so just overall holding the top 500 companies that are the most profitable is probably much better tactic to do. The other thing that the S&P 500 has, it has like 11, I think it's 11 industries within. So you have the technology center, the consumer goods, you have the gas and the oil and the utilities. You have a lot of different sectors within the S&P 500 that are, really highly diverse covered. And so as companies fail, new companies will come in. And so now you have companies that are more dominant and others that fall off to the wayside. And so that's what happens. So if a company struggles and tariffs and regulations, or there's disruptions in the market, so think of, there's always going to be disruptions too. So let's talk about that because, and companies fail because of disruptions. And that could be that they're, we could talk about the Uber and taxis. That would be a really great example. So in New York City, you have the taxi companies. And prior to Uber ever coming onto the marketplace, it was generally that you couldn't just decide to open up a taxi, you had to buy a medallion. And those medallions from, actually, not sure exactly who you bought it from, but it was probably from New York City. They would cost from $100,000 to $1 million to operate a cab. A lot of money to buy these medallions. But then you could operate these taxi companies. And so you'd have these taxi company groups that would operate the cabs, or you could have a taxi driver buy the medallion so they were not splitting the profits that they were making. And so you had taxi drivers who legitimately owned these businesses. But what ended up happening is in certain cities where they really didn't have taxis, Uber came in, and little by little, Uber was introduced into New York, and it started to squeeze the taxi market. And of course, New York came and said, geez, that really wasn't fair to all the taxi drivers out there who spent all this money on their medallion. And now you could have just anybody come in and sign up to be an Uber driver and come in and steal their ride and offer a ride and clean a car, a newer car, a better car, as opposed to these basic kind of Dodge taxis. I don't even know what they are right now, what kind of taxis the vehicles are. I think they're Fords maybe. But you could get into an Uber. Then regulation came into place. The same thing with Airbnb. Regulation came into place to limit the amount of Uber drivers that could be in New York. And so that you didn't just steal the business away from Uber drivers. But that is an area that is disruption. The same thing with the Airbnbs and the Verbos with the hotels. Now there's certain cities that limit because they don't want to lose their hotel base within that city. And there's more control on pricing and all and that stuff. But in every industry, there is disruption. And that could affect who gets into the Standard and Poor's 500. That could affect company profits. So because the world is changing, the companies that remain in the S&P 500 will look vastly different in 20 years from now than it does today. It could look vastly different unless these companies change with the times and become like an Amazon, and they change because Amazon used to only primarily sell books, and most people don't even think of Amazon as a bookseller, but that's what they were. And so disruptions come into the market. Short The other thing is that I don't worry about investing in the S&P 500. Even with all that is going on with short selling, the shorts have to cover the shorts. So they have to return the shares at some point. And yeah, they may return the shares when they take down the S&P down 30%. And then the valuation, the tariffs might be priced in at that point. And so that's another reason why I don't worry, because what ends up happening is in the climate we're in, we could come to a position where all this stuff is worked out, and it could be worked out in the next week or two, and China and the US agree on the tariffs for each side. And that ends up working out for both parties. And so shorts eventually have to cover. They eventually have to buy in, and they're not going to be getting my shares. I'm not going to be selling to them because no one knows what's going to happen with the geopolitical um, climate. And then tariff concerns are real, but they could already be priced in because we've already seen a pullback. So when 259 of the 500 companies express concerns, the market anticipates it and the price starts to be adjusted because the shorts come in, the hedge funds come in, they short the market, a lot of panic selling goes on, a lot of stop losses got hit already, and boom. And I imagine a lot of those institutional investors bought in, and they may have even bought in at a discount. And so they recovered some of their money. So generally, short selling is off the backs of retail investors who are going long and just can't handle the market volatility. Um, Not every company in the S&P 500 is impacted the same way, and I went into it why. And domestic service companies will probably fare a lot better than like the global exporters. So the people who are doing the freights back and forth to all the different places, there's probably not going to be as many freights going. So companies that are doing those kind might be affected more. So the FedEx might be affected more, and the freight companies, I'm forgetting their names, might be affected a lot more than the local companies, even though some of the stuff that they use to make their goods, it's already priced in potentially into how the market just had their uh, had the market has gone through a correction. And then earnings may be compressed, but valuation adjustments can make good companies more attractive. And that's what I see about the overall market. Good companies can become more attractive. So how should a long-term investor react? If you if you don't have to run from the S&P 500, you don't have to run from the overall market. You just if you have a tried and true strategy and you're in it for the long term, chances are things are going to be worked out and it's all going to be okay. You can reduce your exposure. You can, if you are invested in individual stocks, or you're too highly invested into bonds, um, you can diversify into other sectors that might not be as affected. Um, but overall, short selling helps with valuation integrity. It helps balance um, um, pricing so that prices don't go too high, that valuations don't go through the roof, that stocks are not trading on overhype, and that hedge funds will come in and make sure there's a counterforce there to make sure that the prices don't go too high. And then it exposes fraud and bubbles, and it so hedge funds coming in and seeing that Enron came to a place and Enron failed because short sellers came in and they researched and they dug in and they realized there was fraud going on there. So that's how these things happen. And then it prevents the greater fool game. If there was no mechanisms to short, bubbles can only form, and that things can only go higher and higher. So that's why people shouldn't be scared of the shorts. The shorts look at the same thing that the longs look at. They look at the fundamentals of the companies. They look at the overall market, and they're looking at what companies are going to be around for the long haul, and they target the companies that may really not be worthy for consumers to be invested in, for the retail investor, the you and the me, to be invested in. So that's why I don't get concerned about it. And it improves liquidity and volatility control. So when you have short sale going in, it generally eventually stabilizes and the overall market. And it could be that we have periods of time where the market just moves sideways. And then it rewards fundamental research. So shorting rewards fundamental research. So there's going to be times where companies are shorted, like Apple was shorted back in 2008, because people were not looking at the overall fundamentals of the company. Other companies that were shorted was Carvana was shorted. Bank of America was shorted back in 2008. Ford was shorted because of the auto industry collapse. And they had a PE ratio of in the single digits. And the reason why is investors, they thought that that Ford wasn't going to recover, that it was going to be declaring bankruptcy. And unlike GM, it didn't. And then what ended up happening is that a few years later, their stock grew four times its value. So investors that got in and saw the value there um, made a lot of money. And so, what does this mean for the you and the me? This means that investing, that looking at companies' valuations work, that analyzing their business works, that short sellers can expose red flags within companies, that even within overall market, there's a red flag if the market was rising in the face of tariffs. That would be a major red flag. It shouldn't have been going higher. And yeah, if the tariffs go away, then the valuations that we had in the past, then markets will recover. And I think the reality is um, our president in the US could be doing this really just to be looking for a way to reduce our debt or the amount that we pay on our debt. But it's risky what he's doing because of stagflation. And so stagflation is when the economy is equivalent of the worst of both worlds. It's when inflation is high and economic growth is stagnant. And so what often happens, and it could be contracting as well. So what often happens is if it goes alongside with high unemployment, that's bad because then you can't just lower interest rates to fix the problem, because if you lower interest rates, so normally um, in a normal recession, the central banks, the Fed, can cut interest rate to stimulate the economy. But if the economy is experiencing inflation periods, they raise rates. They don't really lower rates. So they're in a position where they're damned if they do and they're damned if they don't. And so if they cut rates, it might help growth, but it could increase inflation. And if they raise rates, it may tame inflation, but it's going to kill growth and it's going to contribute more to the crisis. Now that said, there were historical times where in where we were in stagflation. So that was back in the 1970s, and it was the OPEC embargo, and which drove up fuel prices. And so the EU experienced double digit inflation, high unemployment, and stagnant wages and output. And so the massive interest rate hike that they did at the time reduced the price of oil. But what you should realize is not all things are equal. And so not all stagflation is the same. So tariffs for interest for instance, can increase our price of goods because of the cost, right? So that's going to be inflation. But it's also potentially going to hurt growth, because when cost goes up, then people just can't spend money on the same way that they were spending before. So companies have to cut back on hiring. They have to cut back on investing into doing other things, because they have to concentrate their efforts on reducing and investing in the products they have. Now, could be that this is a time for mergers and acquisitions, that some companies could become more affordable, and you see a lot of mergers going on during this time frame. But I actually see that the government will possibly, I mean, the Fed will lower interest rates, because not all inflation is equal. So even though it doesn't make sense sometimes, and this is why the Fed may keep rates the same, they're going to see what goes on. But over time, the lesser of the two evils may be to lower rates, and that would be to reduce the overall debt that the U.S. has, reduce, help companies as well, because in general, there's two types of inflation. There's demand pull inflation, and that's what we've seen in the past. And that's when the prices go up too high because of demand and there's not enough supply. And that's a strong economy. In the beginning, when inflation was rising, people had the money. And so the Feds raised the interest rate to cool demand, and they kept raising it, right? So that's demand pull inflation. But what we may experience will be cost pull inflation. And cost pull inflation is when rising input costs drive up pricing even as demand stays flat. So I don't see demand really going up. Maybe demand might go be right now in this little short period while prices are rising. But in general, I don't think we're really going to see demand going up if the prices go higher. So the cause, this is like if tariffs, supply chain disruptions, energy prices, labor shortages, or, that's cost pull inflations. So it's tricky because raising rates doesn't fix supply cost. It just risk a recession. Um, but lowering rates may prevent a sharper slowdown. And it can ease credit markets so businesses can stay afloat because if the cost of them borrowing money, if the cost of the materials and the goods go up, if they needed to borrow money, and it also gives households some breathing room. The cost of their credit that they have out, their mortgage loans, if they needed to refinance, so that could ease the burden on some households to give them more money. And it doesn't necessarily mean that it's going to give them more money to spend. It could just reduce the brunt of the tariffs and the geopolitical climate we're in. And then it will help the government avoid a debt spiral from rising interest rates. So I do think that if the tariffs continue to go up, we will see inflation rise a bit, obviously, because of the tariffs, but we will see the Fed lower the interest rates because that's going to be their best bet. But they're going to need to see tariffs actually stay in place. So right now, they're at a standstill of what to do. And that is why the bond market is being affected right now as well. So anyway, I'm staying put. I hope this really helped. Um, with you understanding the market, not being as fearful of what's going on, and understanding that right now this pullback is pricing in what tariffs can be doing. And it is a combination of the longs and the shorts controlling the market, and panic selling into the market is what is helping the hedge funds cover. This is Regina from Simply Fundamental, and I will catch you on the next one. Wow, it was a long video. If you watch this whole thing, tell me you watched this whole thing, and I really hope it was helpful. Talk to you next time. Gotta click it off.